Becky, let me just tell you that we got a press release while just before the number came out. Eric Rosengren, the Boston Fed president, will be resigning as of September 30th. He was scheduled to step down June in 2022, but he's moving that up to September 30th. Kenneth Montgomery, the first vice president of the Federal Reserve Bank of Boston, will take over on an interim basis while the search is conducted. Rosengren citing health reasons, saying he has qualified really for the first time, that he qualified for a kidney transplant in June of 2020, and he has some health reasons that are moving up his retirement. Of course, Eric Rosengren was the subject of some of the conflict of interest stories that we were doing last week regarding him purchasing some of the assets the Fed itself was buying and making multiple trades. So Eric Rosengren, Boston Fed president since 2007 at the Federal Reserve for 35 years of his career, will be stepping down, and he was praised by Fed Chair Jay Powell for his service. Becky? Morgan, thank you. Robert Kaplan, the president of the Dallas Fed, announcing just moments ago that he will retire as of October 8th. Kaplan, of course, was one of the ones who became a focus of a conflict of interest at the Federal Reserve. Kaplan saying that because of the issues surrounding his finances, he made the decision to retire so as not to take away focus from the Federal Reserve. He says, the Federal Reserve is approaching a critical point in our economic recovery as it deliberates the future path of monetary policy. Unfortunately, the recent focus on my financial disclosure risks become a distraction to the Federal Reserve's execution of that vital work. For that reason, I've decided to retire. He's been president of the Dallas Fed for 6 years. A statement put out by the Dallas Fed has Jerome Powell praising him.
It's definitely a surprise. Clarida was expected to leave the Fed on January 31st when his term runs out as governor and as vice chair, but decided to resign early. It appears likely that his decision comes from the new reporting on trading that he did as a member of the Fed, trading in stocks. He sold a lot of stocks on the day before the Fed announced many of its rescue programs back in 2020, and then bought them back. And gives the appearance, even though nothing's ever been shown of impropriety, but gives that appearance. And he originally did not put that in his financial statement, but at the end of the year amended that, and that was reported, and it does look like that he is now joining Robert Kaplan, the former Dallas Fed chairman, and Eric Rosengren, the former Boston Fed president, in resigning because of this trading scandal.
Were you aware of the kind of security buying and selling that Presidents Kaplan and Rosengren were participating in last year? And I wonder if you thought those were appropriate.
So, no, I was not aware of the specifics of what they were doing. So let me just say a couple things about this subject. We understand very well that the trust of the American people is essential for us to effectively carry out our mission.
Bullshitting takes talent. You have none. You are just a blah, 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 blah.
Violations of trading rules. Our Steve Leisman is back on the newsline with us. Steve, you've had a chance to go over this and think about it. What do we know at this particular time?
Fed President Raphael Bostic Scott is revealing that he had trading violations, trades that violated the Fed's trading policies. These violations extended during the full 5 years of his presidency, and they were found under the Fed's new review process, which was adopted in February of 2022. The Inspector General now is reviewing these trades. We understand there were 3 violations specifically. He held more than $50,000 in treasuries. He had extensive trading during the blackout periods and omitted substantial number of transactions from the disclosures. Now, Bostic's explanation, he regrets these trades, says they were inadvertent. They were carried out, he said, by third-party financial advisors, not directed by him or his personal financial advisors. He said he did not personally direct the trades that were in violation. The chairman of the Atlanta Federal Reserve Board of Directors, which basically runs the bank, or Bostic serves at their pleasure, said they accepted his explanation and they welcomed the review by the Federal Reserve Board Inspector General. Scott.
Steve, I'm just going to ask you frankly, I know they accept the explanation. Should we accept that he had a flawed interpretation of central bank policies? I mean, between the blackout period of 150 trades, the non-disclosure of trades, and then, of course, owning more than $50,000 worth in Treasury securities, just all seems just odd for somebody of that stature, especially in light of the scandal that we witnessed just 2 years ago.
Take his ass to jail! Simmer down, simmer down. You go to jail, you son of a... All right, hold him there. You go to jail! Hold him there.
All right. Today is Monday, October 17th, and this is a recap for the stock market activities today. And folks, I got a good one for you tonight. Let's start by this. You're enjoying the stock market rally today, right? The worst is behind us. The bear market is over. Here comes the new, fresh bull market, right? Oh, I'm sorry. What was that? What'd you say? You don't trust the rally? Oh, I wonder why. Maybe sour taste in the mouth? Or a face full of pies, maybe? Because we've talked about this before. No rally allowed. And why is that the case? Number one, the Fed is losing the war against inflation. Inflation continues to move higher despite what the Fed has done so far in terms of tightening the monetary policy. On top of that, any market rally means loosening of financial conditioning, which means higher inflation expectations, which means that the Fed will fall even further behind in the fight against inflation. And that means to catch up, they have to be really aggressive. And do you really want to be standing in their way, fighting the Fed?
No, sir. Not me.
Anyhow, before we dive deep into tonight's program, a few words of appreciation. Number one, for the newest Top Gun Maverick member, Sean McDonald. Somebody downgraded their membership, so you should see your name instead of theirs by the ending of this program. Let's see if you can spot it or not. And then in last night's program, I was thanking the VIP members, and I forgot one name, Jaskaran Singh. Thank you so much for joining. I appreciate it, and I apologize for forgetting your name yesterday. And folks, what we're going to talk about in tonight's program is, what else? More corruption by the Federal Reserve. Anything new here? Not really. We all know that. But the details are really disturbing. But most importantly, how much more corruption are we going to tolerate from the Federal Reserve? These are the same people who are responsible for this inflation. These are the same people who are now crushing the economy, not just the U.S. economy, but the global economy, to clean up their mess. These are the people who destroyed the American dream. These are the people who are destroying the American middle class. At the same time, they continue to get caught doing insider trading over and over and over and over again. And when they get caught, they decide to retire for health reasons or whatever. They remind me of that scene from Casino with the mob bosses. When they get to the trial, they all have wheelchairs and oxygen masks. When nobody's watching, they take the masks off. And this is no different than what's going on with these crooks at the Federal Reserve. And tonight, we're going to talk about one of them, perhaps the most heartbreaking of all, the most disappointing of all, because this guy should know better. Of course, we're talking about Atlanta Fed President Raphael Bostic. And without further ado, here it is, in focus tonight. How about the game? Somebody caught playing the game. And we're talking, of course, about Atlanta Fed President. We got the bombshell report last Friday that the man had to revise 5 years worth of financial disclosures because he found some violations. And by violations, I don't mean a trade or two. I mean over 150 trades that violated the Fed's ethics rules. And what is his reasoning for all of that? He says, he didn't understand the disclosures and these obligations. He did not read the fine print. Or maybe the real reason is, whoops, he got caught. Are we foolish enough to believe that Raphael Bostic was not really familiar with the Fed's disclosure rules? This is the same guy who came out on TV October 21st, 2021, right after Boston Fed President got caught trading mortgage-backed securities, right after Dallas Fed President Kaplan, who got caught trading stocks and bonds. So to say that Raphael Bostic was not familiar with the rules, and this was the reasoning behind the violations that he had to disclose, that is absolute bullshit. Take a look.
So in reaction to the latest set of rules, which affect you and all the other Fed presidents and Fed governors. Do you think it's fair?
Well, fair is not really the standard. I think the standard here is that we need to make sure that we do all we can to preserve and retain the public's trust. Over the last year and a half, we've done as a body things that we'd never done before, unprecedented interventions in the market to try to make sure that our economy got through this COVID crisis with as little damage as possible. But the rules didn't change. And so I think this is a step to reflect and acknowledge that the conditions have changed, our position in the market has changed, and we then need to change our approach to make sure that the public trust is kept.
How do you think about the impact, if any, and potential harm and damage done as a result of this controversy that has unfolded?
Well, I'm hopeful that there hasn't been much damage done.
Yeah, buddy, the damage to the Fed's reputation is coming. I wonder from who? Who's going to damage the reputation of the Fed? But wait, it gets even better.
I guess whether or not damage has been done or trust has been lost, has this step been taken too late? Should it have been taken not really just months ago, but perhaps years ago?
Well, I think the historians will have to answer that question.
Just the last question on this, because I know we want to move on to lots of other topics, but I don't know that it's fair to frame this issue as only arising because of the steps you took in the pandemic. The Fed has always had an extraordinary power over markets, and that has existed for many, many years now. And one just wonders whether you should have been, as a group, more forward-thinking about that in a world that evolves and wants to make sure conflicts of interest were removed. It feels like that's a bit of an excuse to hide behind, as opposed to owning up that a mistake was made, we've made a change, we should have made it earlier.
So I'm not going to get into a debate with you on that here. I will say that once the issue was acknowledged, what we did was act. And I think that that's kind of all that we can speak to at this point.
Yeah, I'm not going to debate these issues with you right now. And by the way, why are you asking me a lot of questions about this? Don't you know that I'm doing insider trading right now as we speak? And folks, the worst part of all of this is the following. The Fed is the enemy of the American public, specifically the American middle class. The Fed is the enemy of the American dream. The Fed is the destroyer of the American dream. The Fed is solely responsible for giving us this inflation, because inflation has always been a monetary phenomenon. And the Fed exploits every crisis that we get into to print more money. And what is the purpose behind that? The answer is the Fed's true mandate, which is prop up, preserve, and inflate the assets of the wealthy, stocks and real estate. So when the crisis, quote unquote, in 2020 hit, the Fed seized the opportunity to cut interest rates to zero and printed a tsunami of liquidity, trillions and trillions and trillions of dollars. Where did the majority of that money go? Not to average Americans. The majority of that money went to the stock market to fluff up equity prices and real estate prices. Both happen to be the assets of the wealthy. The majority of Americans, believe it or not, have very little ownership in the stock market. A lot of Americans are not home owners. And by the way, all of these trillions of dollars that they print, they don't come from thin air. All of this money is racked as debt on the behalf of the American people. The national debt is now over $31 trillion. Now, all of that money is not free. Somebody got to pay for it. And in this case, the Fed borrowed from the future of this country to use all of this money in the present in 2020, 2021 to pump equities and housing prices higher. And the impact of all of that, besides screwing up the new generation of Americans because they're going to have less opportunity in the future with all of this debt, the other result is creating inflation. And the Fed decided to tolerate inflation, to say, you know what? Inflation hasn't been here for a long time. Who cares? Let's print more money. Let's create all of these asset bubbles all over the place. And who cares about inflation? Inflation has been absent for years. It's not going to come back. And of course, people like me have been warning that inflation will come back, and it will come back with such aggression that we haven't seen since the 1970s. The Fed decided to ignore all of these warnings, and even after inflation appeared in the picture, they kept dismissing it as transitory. And now that they realize that inflation is not transitory, what are they doing? They're cleaning up their own mess by destroying the economy. To destroy inflation, you have to destroy the economy at this point by tightening the monetary policy aggressively, which will cause a recession and a global disaster. And Atlanta Fed President Raphael Bostic was no different than the rest of them. Back in September 2020, he decided with the rest of the Fed to let inflation go, and then when asked about the evidence needed to reverse policy, meaning what is the threshold, what is the piece of evidence that will make you guys at the Fed retract and say, okay, time to tighten the monetary policy, the extremely loose and reckless monetary policy that was intended to fluff up equities and real estate prices to serve the rich in this economy. Listen to Raphael Bostic's answer.
Start by asking about the new framework. We know what it is. Appropriate monetary policy will likely aim to achieve inflation moderately above 2% for some time. But what does that mean to you? How do you define moderately above, and how long is some time?
Well, first of all, Mike, thank you for having me on Bloomberg this morning. It's really good to be here. I don't talk to you often enough. But in terms of your question, what I would say is, for me, one of the challenges that we've had historically is that when unemployment or when the employment level has gotten too low, there's been a concern among economists and policymakers that that would trigger inflation that wouldn't be able to be controlled. And so the action typically has been that we're going to try to stop that labor market from overheating, and then in turn that can put a damper on inflation. What we saw over the last 10 years or so is that we could get employment to a very high level without seeing that inflation, and so we wanted to be very clear in the longer run goal statement that we're going to wait to see for evidence of that overheating before we start to take action. And I think that's the biggest, the message to come out of that statement.
Well, what is the evidence that you would look for? Is there a level of inflation above 2% that is kind of your ceiling?
So for me, I would say I'm comfortable being above 2%, and it's actually more the trajectory than the levels. So if we were at 2.2 or 2.3 and it looked like we were going to be stable there for a while, that would be fine. You know, over the last 5 or 6 years, we've been at 1.6 and 1.7 and been at a stable level. So that would be kind of the flip side of that. By contrast, if we were at 2.2 and then the next quarter we were at 2.4 and then we're at 2.6, that trajectory is the thing that would give me some concern. So for me, I'm going to be, certainly the level is going to be something to pay attention to, but for me, the trajectory is much more important.
So Mr. Bostic said that he cares about the trajectory of inflation. If he sees the trajectory moving higher, he will advocate for reversing this loose monetary policy. Guess what happened? In May 2021, the inflation rate shot up higher to 5%, way beyond Raphael Bostic's threshold. The trajectory became clear that inflation is here to stay, and it was time for the Fed to act by tightening this loose, reckless monetary policy of printing money on steroids to benefit the wealthy. And guess what Atlanta Fed President Bostic said at the time? Take a look.
President Bostic, we have time for just one more question, so I want to get your view on the outlook for policy here. Some have said that perhaps the asset purchases have overstayed their welcome, and they're concerned that the Fed's going to be too loose for too long. Are you comfortable waiting this out until we get the unemployment rate down and the 8 million or so jobs back that we lost for the pandemic, staying on the sidelines with policy the way it is right now?
Well, I mean, Steve, you said it. We still are 8 million jobs short of where we were pre-pandemic. And until we make substantial progress to close that gap, I think we've got to have our policies in a very strongly accommodative situation or stance. Like for me, I'm always, I'm a nervous guy. I'm always thinking about scenarios as to are we staying in our position for too long? But I'm not saying that right now, and I'm not really thinking that we need to act. And so I'm going to keep my eyes open, and I'm definitely going to pay close attention. But now is not the time where we have to consider moving.
In other words, no need for tightening the monetary policy at this point. 5% rate of inflation in a matter of months, that's not a big deal. That's actually transitory. That's what Powell said, that's what Bostic said, and that's what the rest of the crooks at the Fed said. Oh, it's just transitory. And by saying it is transitory, they have ignored years and years of evidence that there is no such thing as inflation being transitory. And even after they have admitted that inflation is not transitory, and the Fed has to start a war against inflation by tightening the monetary policy aggressively. Too little, too late. But whatever, even after that, the Fed remains too mild and too gentle in tightening the monetary policy. In May of this year, Raphael Bostic came out and said, there is no need to tighten the monetary policy by increasing interest rates by 75 basis points. He doesn't see that coming. Take a look.
For me, 50 basis points from over the last 20 years, is already a pretty aggressive move. I don't think we need to be moving even more aggressively. I think we can stay at this pace and this cadence and really see how the markets evolve. My expectation and hope really is that as we move closer to our neutral levels and far away from our accommodative stance, that we're going to start to see a lot of the tightness and the tension in the economy start to moderate, which can then give us options and choices as to sort of what we do after that point.
How far do you go? Where do you think you'll be by, say, the end of the year or by the end of 2023?
Well, that's a very good question. I really think we need to be getting somewhere into the neutral range. And as you know, different people have different ideas about what that looks like. For me, I'm looking somewhere between 2 and 2.5% as our neutral range. And then let's just wait and see what's happening.
And of course, fast forward, we got at least so far 3 75 basis points interest rate hikes. You know why? Because these clowns are not in charge. Inflation is, and they're now chasing inflation. This is a dangerous game, because by chasing inflation, by not being in charge, the 75 will become 100 basis points, and the 100 basis points will become 125, and the 125 will become 150 until they get inflation under control. And by doing that, they're going to wreck the economy. And isn't it amazing that we have all of these Fed presidents, all of these PhDs in the Fed, we the taxpayer, paying them millions of dollars, yet these clueless clowns have no idea where the neutral rate is. Well, let me give you a hint. When you have an inflation rate of over 8%, and by the way, this is the Cook number, the real number is in double digits territory. We all know that, but let's say it is 8% plus. Do you really think that the neutral Fed rate is at 2.5%? Who are these clowns? Even I know that that's not the case. And I'm just a douchebag YouTuber doing a show from my garage. You see, now the Fed is chasing the market. The market says the neutral rate is actually above 4%. The Fed remains below 4%. The Fed funds rate is at 3.5%. And every time we get an inflation report, the estimates for the Fed funds rate continue to go higher and higher and higher. In other words, the Fed is way behind and they have to become even more aggressive. The actual pivot is coming, and it's going to wreak havoc on the global economy. For example, when the Fed tightens the monetary policy aggressively, the value of the US dollar moves higher. Less printing of money, that causes the currency to appreciate. In this case, the dollar, the global reserve currency, is moving higher astronomically in a short amount of time. What does that do to the global economy? How about a global hunger crisis? You know why? Because all of these poor countries have to buy food commodities using US dollars. Well, if their currencies are collapsing because the dollar is surging higher, they cannot afford food. So this dangerous game that the Fed is getting into has huge ramifications and consequences, including destroying the global economy, causing a massive tsunami of layoffs and job losses, pushing the economy into a recession, and oh, by the way, how about a hunger crisis? And what is Raphael Bostic's response to all of this? Here it is.
We've already had 2 back-to-back quarters of negative GDP growth, which would put us in that category of recession. How significant of a pullback are you expecting here?
Well, first of all, I think that the GDP number is one way to think about the economic performance, but many others would suggest that the economy has a lot of positive momentum. We're still creating lots of jobs on a monthly basis. And so I actually think that there is some ability for the economy to absorb our actions and slow in a relatively orderly way. Look, we need to have slowdown. There's no question about that. But I do think that we're going to do all that we can at the Federal Reserve to avoid deep, deep pain. And I think there are some scenarios where that's likely to happen.
Deep, deep pain, or that you can avoid the deep, deep pain?
Oh, that we can avoid the pain. Thank you for that. Sorry.
Yeah, ha 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 ha. Did I say that you guys are going to experience a lot of pain? I mean, we're going to try to do our best to avoid that pain, but there are no guarantees here.
Alan Blinder, the former vice chair of the Federal Reserve, wrote a piece in the Journal this week, and he said the chances of a softish landing based on history are well under 50%, but above 0. What are the odds here that this is a soft landing?
Well, I'm not an odds person. People who know me know I don't like to gamble because I hate to lose money. But I will tell you, this is something that is going to be hard. It's not going to be easy. There will likely be some job losses. But I think if you look over the historical history here.
Historical history? What the hell is that? And of course, he admitted that there is going to be pain in terms of higher unemployment. He is sugarcoating it so far, saying maybe, maybe not. We're going to try to avoid it, but he knows it's going to be ugly. There hasn't been a tightening cycle in Fed history that happened in such rapid pace. And why is it happening in a rapid pace? Because the Fed has been playing the game of, inflation is transitory. And now they're playing catch up, raising interest rates from 0 all the way to 3.5%, and now the market says over 4.5%, perhaps 5% in a short amount of time. This will cause a lot of destruction in the economy. Think about the company that employs you right now. If the interest rate on their debt continues to move higher, if the Fed causes a recession because they're tightening the monetary policy and they're making money more expensive, what do you think will happen? Your company has to cut expenses, and your head might be on the chopping block. They have to get rid of employees to reduce their expenses. In other words, unemployment will rise higher. No doubt about it at all. And then he says he's not a gambling man. Oh, really, Raphael Boystick? Need I remind you with the game, the fact that you and the rest of the Fed morons turned this economy into a casino?
Brings me to another area of criticism that some folks have leveled at the Fed, which is the idea that the Fed's policies do little to actually reduce the inequality in terms of employment. They do a lot to increase the wealth inequality, which is increasing folks' portfolio prices, increasing stock prices, increasing housing prices. And that exacerbates the unevenness and the inequality of the economy.
In order to play in that game, you have to have assets. If you don't have a job, there's no way you're going to get to assets. I want our institutions and I want our policies to work in a way that many more people get jobs than have historically, because then they can actually start to build those assets.
Absolutely.
So they can be in that game.
In other words, what Boystick is saying, hey, look, the economy is a casino. All what you have to do is get yourself a job, and the job will give you chips. You get these chips and you play the game in the casino. And we, the Fed, will rig the game in your favor. We're going to manipulate the game by borrowing money from the future, printing more and more money in quantitative easing to make the game in your favor. Now here's the problem. Average folks, they have bills to pay. They have to pay for food and gas and expenses and rents. They got no time and money to play the stock market. So at the end of the day, who does this policy benefit? Turning the economy into a casino. It benefits the rich. Those with the means to play the game, not average citizens, not the poor or the middle class. And when you really think about the game concept, in essence, it is trickle-down economics. We're going to rig the economy to benefit companies, corporations, the rich, the 1%, and they, in turn, should create jobs. Once they create jobs, those employees will have the chips needed to play the game too in the casino. And of course, the reporter had a good rebuttal to all of that. Take a listen.
I don't think anyone disputes that that's what you all want and are attempting to do.
But I think they do, because for us to succeed in the job side, there's also going to be success on the wealth side. You can't get one without the other.
Is there a thought given to our policies aren't working the way they used to because the economy doesn't work the way it used to? It used to be that when we lowered interest rates, businesses hired workers. Now when interest rates get lower and businesses can just borrow money to load up their balance sheet with cash, and they enrich the people at the top, the C-suite executives. And it exacerbates inequality and the unevenness of the economy that you talked about.
I have a different narrative.
He says, I have a different narrative. Yeah, buddy, your narrative is to serve your sponsors, the 1%, the banksters. Those are the people who benefit from the Fed's policy, not average folks. And maybe it used to be back in the 80s that trickle-down economics did work, at least for a period of time, because companies did use the money to hire more employees and expand. Not these days. Under quantitative easing, corporations get all of that money, trillions and trillions of dollars. What do they do with it? Hire employees? Of course not. They ship the jobs overseas to benefit from starvation wages. And what do they do with the money instead? How about share buybacks? They buy back their stocks, fluffing those equities prices higher so they can sell and make more money. This is a rigged game. That's what it really is. And this is not a way to build an economy. No wonder why this financial engineering called quantitative easing is now ending in a disaster. We have the highest inflation in 40 years, and to kill this inflation, the Fed will wreck the economy like you have never seen before. I mean, look at what's going on right now. The Fed, the central bank of the world, is now losing money because they bought all of these assets at fluffed up valuations using the funny money from the printer machine. And now that they're tightening the monetary policy to control inflation, the value of all of these assets went down by a lot. And now the Fed, the central bank of the world, is in the red. Do we even know what the consequences of that? Have we ever been in such scenario before? Do you think that this will happen with no consequences to the economy at all? Think again. But hey, you don't have to listen to me. I'm doom and gloom all the time, right? Maybe you should listen to another Fed crook from Chicago this time around, Evans, who says that inflation will go down, and it's going to go down without causing a recession, and we will have a soft landing, and everybody's going to live happily ever after. These are the same people who told you that inflation is transitory. And I wonder, when are we going to hear about Chicago Fed President Evans and his insider trading scandals? Anyhow, folks, the show must go on. We have to cover the stock market information for you. And we begin with the closing of the indices today, and here we go. The Dow Industrial Average closing in the green big time by 550.99, can we say 551 points, or a gain of 1.86%. The Nasdaq also in the green, leading the pack with 354.41 points, or a gain of 3.43%. The S&P 500 up by 94.88 points, or a gain of 2.65%. The British pound was up in the morning, the dollar was down. The algos did the majority of the heavy lifting. Did we see some buying from the retail crowd? The answer is yes, but the majority of the action was done by algos because the majority of the gains happened via the gap up in the morning, and there was little follow-up in pushing the tape higher after that. In any case, when we look at the sectors, at number 1, capturing the gold medal, cyclicals; at number 2 for the silver, real estate; and at number 3 for the bronze, communication services. We're not going to shame any sector of the market because all of them managed to close in the green. When it comes to the advance to decline ratios, the NYSE 91% advancing versus 8% declining. The Nasdaq 76% advancing versus 21% declining. When you have the algos combined with short covering in the morning, you get what we got today in the NYSE, 91% advancing when it comes to the breadth. We haven't seen this in a long time. Moving on to commodities, while the dollar was down, we have seen some positive reactions when it comes to commodities, but not by much. As if commodities are saying, yeah, we're not buying the fake out by the dollar here. The dollar perhaps is playing possum, and then it pops higher again, and down we go in commodities. In the meantime, energy commodities were muted for the day. They were initially higher, but they closed pretty much on the flat line. The WTI, Brent with modest gains for the day, along with the RBOB, gasoline, heating oil, all pretty much in the flat line. On the other hand, natural gas was down big, and the reason is the mild weather that we have so far here in the United States. But we have a major tailwind for natural gas, which is what happens if the winter season comes out ugly across the Atlantic and Europe. They're going to burn through whatever they have right now in inventory. And then what? They have no other choice but to stock up and buy US-based LNG because the Chinese are saying we're not going to sell any more LNG to Europe. The Chinese want to preserve whatever supplies they have for domestic consumption. Now, when it comes to softs, we have yet another day worth of gains for OJ futures, up almost 2% for the day. And then we have yet another positive day for lumber, with gains of about 1%. On the other hand, we have flattish action for cotton futures, while we have modest declines for coffee and sugar futures, but we have losses here worth about 2% for cocoa futures. Now, when it comes to metals, the dollar was down today, and naturally, gold up, silver up, platinum up, palladium up, but copper is down. So is copper a leading indicator that today's action in the dollar was a fake out? We'll see what happens. We have another indicator in gold, by the way, that says the action that we got in the dollar is a possum playing dead. We'll talk more in the charts analysis, but for now, what about meats? Green across the board. And the gains were led by the new big tech lean hogs, with gains of over 3% for the day, followed by live cattle futures, and then feeder cattle futures with about 1% worth of gains apiece. Now, when it comes to grains, we have muted reactions by soybeans, wheat, soybean meal, rough rice futures, all pretty much flattish. On the other hand, we have losses led by corn, followed by canola and oats futures. And the winner is soybean oil futures with gains of about 2.5%. Why did soybean oil surge higher today? The answer is We have drone attacks in Ukraine that hit a sunflower oil factory in Mykolaiv. So now we have a shortage of supply in sunflower oil. The substitute is soybean oil, and therefore we saw soybean oil futures moving higher. On to the big casino, the options market. What's going on here? The volume all in all is down. What does that mean? We don't have a confirmation of the action that we got today. Had we seen the call options volume surging higher along with the positive reaction that we got in the market today, we would have said, hey, the algos did the heavy lifting in the morning and then the retail crowd, the traders showed up and they did buy calls. Looking at the volume right now, we cannot say that that is the case, even though the put to calls ratio is improving. Now, number one, the hottest table by far in the casino is Tesla, the souffle, with around 1.5 million contracts traded today. About 55.5% of those were calls. And at number two, Apple, with around 950,000 contracts traded today. About 52% of those were calls. At number three, Amazon, with around 750,000 contracts traded today. About 56% of those were calls. On to the unusual activities that took place in the options market today. We start with a ticker DKS for Dick's Sporting Goods. Somebody sees a downside coming for this name, and it also could be a shareholder hedging before earnings, and they decided to buy the 85 puts for the expiration date, December 16th, with expectations that Dick's Sporting Good could move down and lose more than 23% of its value by then. They paid around $2.70 a piece to enter this trade, all in all spending around $3 million. And then what about the ticker AMZN Amazon? Somebody's failing the rip here by buying the 108 puts for the expiration date, October 28, with expectations that Amazon could move down and lose more than 5% of its value by then. They paid around $2.85 a piece to enter this trade, all in all spending around $2.7 million. And then what about the ticker CTRA Coterra? This happens to be a name that I trade and own from time to time. Despite all of the headwinds that we have against natural gas, we also have a lot of strong tailwinds for the name to move higher. Now, this trade is two-legged, meaning we have two legs for the trade, one bullish, one bearish. And you can interpret this any way you like. I have at least about 3 to 4 ways I can interpret this trade. I'm going to use the one that I believe is the case. And what I see here is a trader is making a bullish bid for CTRA by buying the 31 calls for the expiration date November 18th. At the same time, they're financing this trade by selling the 24 puts for the same expiration date. What does that mean? It means the trader is saying, I see CTRA trading above 31 by the expiration date of November 18th. But if that doesn't happen, and we see more losses for the name to come, I'd like to limit my losses, number one, by selling another leg. Number two, if the name crashes and moves all the way below 24 by the expiration date of November 18th, the trader is willing to buy shares of Coterra at $24 a share. And by using this interpretation, the trader paid around 90 cents a piece for buying the 31 calls, and they received in credit about 40 cents a piece from selling the 24 puts. All in all, the entry cost is reduced to 50 cents a piece at around $350,000. On to the heat map. What's going on here? A sea of green, a rebound rally, a very inclusive rally, be it tech, be it energy, be it materials, be it industrials, all up, all trading in the green, with very few exceptions. One of them is Charles Schwab. The ticker SCHW was down a little over 2.25%. We have seen a negative reaction from Morgan Stanley last week, even though JP Morgan, Bank of America, which reported today to, experienced positive reaction. Why? Why are we seeing the contrast here? The answer is the community banking centers, let's say JP Morgan, Bank of America, they benefit from rising rates. Yes, they lose a little bit of money from investment and trading, but the benefit from rising rates covers for all of that, at least for now. On the other hand, names such as Morgan Stanley and Charles Schwab, which depend on trading revenue, we know that the stock market mania is over now, and therefore the trading revenue is down for all of these companies, and hence the negative reaction by Morgan Stanley and Charles Schwab. And by the way, Morgan Stanley is now evaluating cutting jobs. So what did I do with this information today? I did fade the rip in Goldman Sachs. Goldman Sachs is due to report earnings tomorrow in the morning, and my hunch is the trading revenue will come down, and therefore I'm fading the rip in Goldman Sachs by buying puts. No guarantees here that this is going to work, but I'm going to do an earnings preview by the end of this video. I'm going to cover Goldman Sachs chart. Stick around till the end of this video. But we have news for Chinese stocks, the likes of Alibaba, for example. All of them surged higher today, and this is based on the news that we got over the weekend that Chairman Xi won a third term. And boy, this election was too close. I had no idea that he's going to win. So on behalf of the Maverick for Wall Street channel, I'd like to congratulate Chairman Xi for winning the elections. I hear it was a tough one. And then we have news for BlackRock, BLK, and apparently the insiders are dumping for whatever reason. I wonder why. The latest is $97 million worth of BlackRock stock. And then we have Starbucks, and this is absolutely annoying. This is exactly what's wrong with the Gen Zers, aka the TikTok generation. They see all of these stupid videos on TikTok about customizing Starbucks drinks, and they go to the baristas and they order these complicated drinks. And the barista has to go to the manual and read how to make these drinks. And now the baristas are asking for more money, more benefits. Hey, we're putting more effort here to serve these rugrats. Can we get paid more, please? So Starbucks has a unionization problem, a wage inflation problem, an input price problem. And what's keeping Starbucks floating for now is we haven't seen a rise in unemployment yet. Keyword yet. Once we see unemployment rising higher, say goodbye to Starbucks because they have to close a lot of stores. And then following up on Meta, aka Facebook, the disaster of Mark Zuckerberg. We talked about him in details in a separate video, but now we have more details on this fantasy, this lunacy he calls the metaverse. The headline reads, Mark Zuckerberg's metaverse is getting slammed in an internal documents, and the documents say an empty world is a sad world. And this is exactly what the metaverse is. And on top of that, the Wall Street Journal says most metaverse users don't even make it a month, with horrible graphics, with no legs. And oh, by the way, you might get accused of sexual harassment because your avatar bumped somehow into another avatar. No thanks. And now even the analysts are saying that Mark Zuckerberg is telling us that he does not think he has a core business. What is the business here? Is it an ad company? Is it a video game company? Is it a fantasy company? Is it a lizard company? We have no clue. And perhaps better yet, you might want to buy Roblox instead, because Roblox is up over 20% today on user growth. So we have users moving away from the metaverse. No thanks, but the user growth in Roblox is still intact. And I say, folks, this is yet another shorting opportunity. It's not a buying opportunity. You're not going to short it right away. You're going to wait for it for a little while, let the short covering happen. And then as it gets closer to earnings, if the stock remains elevated, that would be an opportunity to short. You know why? Because this company is still richly valued and interest rates continue to move higher. And this company has a lot of debt in its books. And then we have LVMH, and apparently all of these rich oligarchs, the WEF-aligned oligarchs who keep schooling us and lecturing us about saving the environment. Well, apparently they don't care about the environment. This is just an act. A charade, a sham, because they continue to use their private jets over and over and over again. And now they're all ashamed because apparently we have tracking. We can find out and see how often they use their private jets and how far. And once that got exposed, and we found out that these oligarchs are taking short trips, 9 minutes each, 15 minutes each, using these massive private jets, they're now ashamed. And this French oligarch is saying, you know what, I'm dumping my jet so people won't track me. And instead, he's going to sell the jet to the company, and the company is going to rent it back to him. And that way, nobody's going to be able to track him. There you go. It's not about the environment. It's not about the climate. It's about please don't shame us. We're a bunch of hypocrites. And of course, nobody's a bigger hypocrite than Reverend Elon Musk of Tesla, Starlink, the other monkey chip in your brain company, because he takes private jets all the time. The most notorious one is when he took a 9-minute flight from San Jose to San Francisco. Now you might say, but Reverend Elon saves the environment. He's making Teslas an EV. Yeah, he's making Teslas an EV to rob the taxpayer. Anyhow, on to the heat map for the ETFs, a sea of green. There is no theme here. Yes, growth is outperforming value by a little bit, but all in the green. So we cannot say that we have a theme here. We cannot say that this is a sustainable rebound because everything is in the green. That means we have seen a lot of algorithmic buying combined with a lot of short covering in today's tape. Now, if it was dumping value in favor of growth, we would have said, okay, we have something different here. We have conviction of investors and traders moving away from value in favor of growth because the Fed is pivoting, the dollar is going to go down for good, interest rates will go down for good, and tech valuations should move higher. This is not what we've seen. Instead, we're seeing a short covering inclusive rally. So we're going to move on to the charts analysis, and we start with the SPY 30 minutes chart for the S&P 500. We got a gap in the morning and very little follow-up. consolidation all the way till the end of the day, just below the resistance at around 368. Now, in last night's video, we talked about a potential of an ABC pattern. And the question is, are we seeing the ABC pattern playing out? For now, the assumption is maybe. Maybe it is playing out because this is a bull flag consolidation pattern. And on top of that, the chart is above the June bottom of 362.16. Now, the case would have been, that is, a lot stronger for an ABC pattern if the trading was continuous. If we did not have a gap up, because a gap up opens up a lot of other possibilities of short covering, of algorithmic reaction, and then we see the crap and the move down to close the gap. Yet when we play the odds for now, we are ahead of earnings season. The market is heading into earnings season, beaten, bruised, lots of shorts, have to take profits. On top of that, the volume moves down because a lot of traders don't want to make one move or the other. They want to wait for earnings and then do the move. And therefore, for now, looking at it right now, it favors the ABC pattern playing out, meaning it favors the bulls to move all the way perhaps to the resistance at around 373.5. Now, the bears should not be aggressive at this point. They should become aggressive in doubling down in shorting and betting against the market if we have, number one, a loss of the June bottom of 362.16, but that's not enough for me. I'd like to see the gap being closed and then the chart moving below the gap, and better yet, making lower lows. On to the daily chart for the continuous contract for the S&P 500. The bulls made a lot of improvements today. Number one, the volume went down significantly. That's a good sign for the bulls. Number two, the momentum indicators are improving, be it the RSI or the MACD. Number three, they're keeping the support at around 3,600. And now the bulls could say we have a double bottom, triple bottom, whatever it is. They can place and hang their hats on that hope that 3,600 is the support and is the bottom. Now, we know this is not going to be the bottom, but is it a launching pad for a relief rally? It certainly could be, but the bulls need to be more persuasive. What do I mean by that? They need not just to keep support, they need to break above resistance levels and turning them into support. So far, they did not do any of that, at least not today. And we are talking about 3,720.5. If that becomes support, solid support, then we're talking. But even after that happens, there is still a long way to go to say that 3,600 is intact at least all the way till the end of the year as support. Now, what about the bearish case? We talked about that in details in yesterday's video. So we're going to move on to the Qs, 30 minutes chart. What's going on here? We also talked in last night's video about perhaps an ABC pattern in play here in the NASDAQ. And the question is, are we seeing the ABC pattern playing out? For now, what we know is, number one, the chart is consolidating at around the June bottom of 269.29. forming what it appears to be a bull flag pattern. However, it also happens to be a reversal point from which the Qs reversed and moved all the way, cutting a lot of the gains from last week. So it's not going to be easy here for them to break above this resistance, which happens to be the top of the reversal candle from last week. However, one way they can cheat in all of that is by a gap up in the morning, and then you don't have to worry about it. And it appears from now, at least at the time of the recording of this video, that this is what they're planning to do. When we look at the daily chart for the continuous contract for the NASDAQ, we see a gap up, at least for now, and the chart is trading above the June bottom of 11,058.5. Now, the good news for the bulls, the volume is down. The momentum indicators are firming up by a little bit, not by a lot. Nothing significant here, but they have managed to recapture the June bottom for now. So all in all, the bulls are making a lot of advances here. Is it going to last or not? That depends on the volume. If the volume shows up, it's going to come out for the negative/bearish side, and it's going to flush the chart down. Now, let's take a moment and think, what would be the catalyst for the volume to move higher? The answer is, how about earnings? We have an important one coming out tomorrow in Netflix, and then after that, we have Tesla. If any of these two bomb, we will see the volume moving higher. And if it does, it will come on the selling side. So this is one thing the bulls must be watching for. And we discussed the bearish case in details in last night's video. So we're going to move on to the IWM, the Russell 2000 30 minutes chart. Again, ABC pattern. For now, it is consolidation in a bull flag pattern, and the chart is eyeing 174.22 as resistance. If it moves down and it loses 168.90, then you know that this was a dead cat bounce, a gap and crap, Nothing to see here. But a recapture of 174.22 is a significant development toward the bullish case. And perhaps the bullish case depends on this chart, the Dixie, the dollar index, and for now, it traded down. And that solidifies the bullish case, bullish for equities, bearish for the dollar, that this could be a reverse ABC pattern. And they have a lot of support in this theory because we have negative divergence on the RSI. If we see a cut below the support of 111.5, and on top of that, losing the trend line in yellow, that would be a major advancement by the bulls, and it will solidify the case for a relief rally. The problem is, as the dollar goes down, commodities will go higher again, and so will inflation expectations, and as a result, so will the Fed rate hike expectations, and this is not good for the market. For now, we have a leading indicator in gold that says, I'm kind of skeptical about the move in the dollar today. Meaning I'm kind of skeptical that the dollar is going to go down and the reverse ABC pattern will play out. Why do we say that? Because gold did not make it above 1,671 even though the dollar was down. On top of that, the MACD indicator is showing negative momentum. At least for now, it is not decisive, it is not significant, but it is showing negative bearish momentum. So we don't have a confirmation by gold that the dollar should move down. So watch out for that. And then we have the daily chart for crude oil Brent. What's going on here? One way we can look at it as a bull flag pattern. Another way is an ABC pattern. For now, oil is forming the B leg. Sooner or later, it forms the C leg. And we see higher highs. All of these hopes and dreams go out of the window the moment we see crude oil futures moving closer to 85. We don't have to see a breach of 85, but if it gets closer, let's say 88, 87, we'll know that the case for an ABC pattern is getting a lot weaker. And here's the daily chart for the 10-year yield. What's going on here? It is moving its way higher. It wants to break above that resistance, and so far, it appears that the bulls, we're talking about yield bulls, not equities bulls, are having the advantage here. We're not going to say that this is over and yields are going down, so equities should go higher until we see a decisive pattern that we have a double top indeed. And that's not going to happen until the chart breaks below the lower range of the pattern that I'm pointing at right now. If it's broken, then we know, okay, we got the resistance, double top, and down we go. We're going to skip the TLT because we talked about it in details in yesterday's video, and we have no update in today's action. So we're going to move on to the VIX 4 hours chart. What's going on here? It is showing negative momentum, but it is also showing relative strength. What do I mean by that? The SPY is up big for the day. One would assume the VIX should be down big for the day, but the VIX was only down about 2% or so for the day. And I see that as a warning sign that whatever this is, a relief rally, a rebound rally, a dead cat bounce, a bear market rally, doesn't matter to me. Whatever this is, the VIX says it's not going to last. Until we see the VIX having a double top formation at 33 and making lower lows in the pattern. For now, we're not even close to that. What about Apple, the big kahuna, daily chart? What's going on here? We have some improvement. For one thing, the volume is down, not by a lot, but it counts. And another thing is the momentum indicators are improving. Look at the MACD indicator. We have a mini baby positive reaction for now. The problem is the chart did not make real progress when it comes to capturing support levels. Resistance remains resistance for now. It happens to be the gap, previous gap that we've seen before, and the chart stopped short of that. But if you want to be positive, it did keep the support of 138.79. The problem is, does that really matter here? Does this change anything? The answer is not yet. We need to see Apple above 145 to say, okay, at least we have some cushion here. That is 145 and then about 142.5 before the last support of 138.79. Otherwise, the assumption is sooner or later, Apple is going to crack below the support of 138.79. And here's Tesla, an hourly chart. What's going on here? We talked about Tesla breaking below an important support of 206.86. This is a negative reaction. However, we got a gap higher today. And I was watching the chart of Tesla today, and I noticed that this is short covering before earnings. Tesla is going to report earnings this Wednesday, I believe. And since the stock is down big heading into earnings, just looking from this chart alone, it went down from 310 all the way to below 206. The chart lost almost a third of its value in a short amount of time. Is it really a surprise that we're seeing some short covering and profit taking ahead of earnings? It's not a surprise to me, and the chart is now forming a bull flag pattern at around 217.88. Yet it will face a stiff resistance at around 226.26, which happens to be the top of the reversal/rejection candle. Now, make no mistake, the fact that the chart broke in below 206.86 and it lost almost a third of its value in a short amount of time ahead of earnings, this could be a leading indicator that the report is really, really ugly. If that is the case, the bears should be hoping that Tesla rallies into the report, and then we see another flush down. However, if you happen to be bullish Tesla, you should be betting on the fact that maybe the reaction that we got so far, down almost 30% in a short amount of time, is an overreaction. And then the report comes out negating this reaction. If that is the case, we will see a big short covering rally in TSLA. And lastly, what about Bitcoin, tulips? Any update here? Not really. Within the consolidation range, nothing to see here. So let's move on to the conclusion of this video, and we start with what do we have on the economic calendar tomorrow. We have the Industrial Production Index. On top of that, we have the Capacity Utilization Rate and the NHB Home Builders Index. And then look at that, we have Atlanta Fed President Boystick, aka The Game, speaking. Is he going to apologize? Are the reporters going to ask him, hey, did you watch the Maverick for Wall Street last night? I doubt it. And on top of that, we have the demon from Minneapolis, Neil Kashkari, speaking. Now, what do we have on the earnings calendar? We have Goldman Sachs, J&J, Lockheed Martin, Netflix, and United Airlines. Let's take a look at some of those. We start with Goldman Sachs. Here's the chart, the daily chart. Are we seeing a reverse ABC pattern? This is what I'm betting on. I believe that the trading revenue will come out short and the stock will have a negative reaction. We'll see what happens. No guarantees here. These are risky trades, folks. Keep that in mind. And then we have Lockheed Martin, and I happen to be a shareholder of the name, and therefore I did buy puts by the close today. Now the name is heading into earnings down about 17%. So if we have any positive news regarding new orders, this is what I'm watching for. The stock will pop higher. But in case it doesn't and it goes down instead, at least I am insured and protected. And of course, the most important report is going to be from Netflix after the bell. Now, Netflix is heading into earnings up about 50% from the bottom. In other words, the bar is set really high, and if the name doesn't deliver in the report, the likelihood is it will go down. Yet we know from history that Netflix tends to overreact after the report is out, be it to the upside or the downside, and then what do you know, the next day it opens up flattish. Now, this is usually true for the upside, meaning if Netflix pops higher after the bell, the likelihood is the majority of these gains will be cut by the open in the next day. Not so much when the reaction after the bell is negative, but in any case, I gotta let you go now. This is all I got for you for now. Thank you for listening. Thank you for watching. I will talk to you again tomorrow. Take care.
Seriously, I never should have left Goldman Sachs.
Hey, Goldman Sachs, on behalf of the American middle class, you.